This is Tim Phillips, Chief Investment Officer at Phillips and Company Advisors, and I'd like to welcome you to our Q4 2020 look ahead. Please read all the disclosures and disclaimer carefully. Will they consume? With 70% of our economy supported by consumption, it's always a question we need to answer. Jobs, wages, and confidence are all critical components to answering that question. Jobs look to be improving dramatically from the COVID-19 lows in April, and wages continue their upward climb across income quartiles. As for confidence, it's understandable that with a global pandemic, consumers were downright scared. They're climbing out of that as reflected in recent consumer confidence surveys, and in fact, we saw a bump in consumer financial conditions off of the COVID lows in April. This is all leading to consumers spending on things like homes, autos, and other long-term finance goods reflected in non-revolving credit. Our guess is they will continue to consume. High-frequency indicators suggest consumers are adjusting to the pandemic new normal. TSA traffic at airports has improved by almost 100% off COVID lows. Driving's back up above pre-COVID levels, while naturally crowded public transit trends are still struggling to regain their footing. This is an important trend to watch if you're a municipal bondholder in transit authority bonds, especially the largest New York Transit Authority. Hotels and restaurants are also making a comeback, albeit still well off their high water mark in February. All of this domestic consumption will ultimately benefit U.S.-based corporate earnings. It's important for our investors to realize this is part of an earnings cycle. Allow me to explain. Right now, valuations are very high because earnings have been shrinking and equity markets have been up. It's our view investors have fully discounted terrible 2020 earnings prospects. However, when you're looking forward, year-over-year comparisons show 2021 with great growth. Perhaps next year we might have muted price appreciation and an earnings recovery, which should drive down forward valuations closer to the 5-year average. Growth versus quality earnings is always a paradigm we consider. We continue to evaluate quality earnings as an opportunity to exceed portfolio benchmarks. Values trading at much lower earnings multiples, and that's been the case for a very long period of time. However, there are some economic conditions that might support a drive back into quality earnings companies. Things like low inflation, that supports pricing power for quality companies. Lower interest rates, in our case, real rates near or at negative levels should drive investors into quality dividend-paying companies. That's especially true next year when fixed income investments have little in the way of price appreciation and will only pay out the coupon, sometimes less than 1%. Third, less confident investors might also rotate to quality earnings companies with consistent cash flows versus chasing the high-flying tech sector. For these reasons, we're evaluating a split between growth and value or quality earnings in our portfolios. The world is still full of cash, and that's why markets bounced quickly in Q3. We witnessed a classic correction in this last quarter, and we experienced a quick recovery because the world's full of cash. Consumers are sitting on substantial amounts of savings, and you can see they've been spending down those levels on the top left. Bank deposits are at almost 16 trillion, and that's a record. Money market funds, both retail and institutional, are extreme levels. It doesn't take much for consumers and business to tap into these reserves, just a bit of confidence and some stability. While we're seeing some confidence off of very extreme low levels, moving past the election will help unleash this powerful weapon on our economy, in our opinion. If you just look at the savings rate and returned it to pre-COVID levels, you could add back 1.97 trillion into our economy, or 9.1% to GDP. That's really nothing to miss out on. As many of you know, we've had an overweight in emerging markets for quite some time. Our rationale for overweighting emerging markets is really simple. Compared to the US and other developed markets, emerging markets have lower forward valuations, higher expected earnings, and GDP growth rates. Quite simply, these are the drivers to our overweight with emerging markets equities, and that's especially true in China. China and mean reversion, or could China be on a long road back to global dominance? First, real-time indicators suggest China's made a full recovery from COVID-19 and for the most part functioning at or above pre-COVID levels. Restaurants are in full demand and basic commodities like steel are at very high levels. Further, both manufacturing and service sectors have bounced back to pre-COVID levels. Now, I'd like to zoom out a couple thousand years and have you reflect on the fact that China once dominated global economic output, as did India. It's really only the last 250 years America's been the global economic heavyweight. Now, it wouldn't surprise me if we were in the middle of a very long road back to global dominance by China. Of course, America will react and respond, but it's natural for China to want to grow and prosper. That's exactly why we have a specialty focus on China and access to their domestic equity markets. Now, notwithstanding the current political rhetoric from the US administration, China's an incredible force for generating positive returns. In fact, I'd encourage you to take a look at a recent interview I did with Kevin Xu, a leading China expert. The link is below. I hope this sheds some light on we think China has a place in most portfolios. Let me quickly pivot to developed markets, especially European Union and Japan. Stagnant earnings and GDP growth expectations combined with high forward valuation underscores our underweight in these markets. The Fed came out and made a game-changing move. They effectively said they're lifting their 2% hard inflation target and will allow inflation to run moderately above 2% for some period of time. You can read Chairman Powell's statement above. His intent, in my mind, is to help lift wages for those at the bottom of the income spectrum, to include Hispanics, Asians, Blacks, and whites. In the past, the Fed would raise rates when inflation would kick in to curb excesses, and that would also curb wage inflation or wage growth. It would appear the Fed wants to use their tools to narrow wage disparity and improve lives for those at lower income levels, and we applaud that. When you consider markets can trade with reasonable valuations up to 3% inflation, perhaps there's an economic sweet spot the Fed wants to explore that creates wage winners and investor class winners. Either way, the Fed looks like they've just institutionalized lower for longer when it comes to interest rates. At the time of this recording and just after the first debate, we'd be remiss not to discuss the upcoming presidential election. Currently, Vice President Biden is leading President Trump in both national and key swing state polls, with the enthusiasm gap for candidate Biden appearing to be his biggest issue. While there's plenty of water to go under the bridge, we should look at what are the likely economic outcomes of a Biden presidency based upon his tax policy. From our friends at PIMCO, they took a stab at what would be a negotiated tax plan. No president gets 100% of what they want due to tax writing committees in the House that have some pretty high hurdles and stringent rules to get things done. Certainly higher income tax rates, lower estate gifting thresholds, and perhaps some relief on property tax deductions will be in order. It's highly unlikely a wealth tax would clear a Supreme Court with a strict constitutionalist majority, and that court might even rule the 3.8% Obamacare surcharge unconstitutional. That's something we should look out for in the coming weeks to months ahead. Like investing, as in politics, anything can and likely will occur in this political silly season. As you review our mean reversion dashboard, I want to caution you that none of this makes a whole lot of sense as we've just come through a tremendous collapse in earnings due to COVID-19. That'd be the similar case with our economic dashboard, as economic indicators are completely out of whack, again, due to COVID-19 and the global pandemic. Our views are pretty straightforward. Political silly season will be a disruptor to markets during the quarter to include post-election disputes. That could possibly create a 10 to 20% drawdown. Cash flows will continue to improve as more businesses continue to open up and consumers return to more activity, with the combination of testing, treatment, and a vaccine dominating post-election headlines. Certainly, the Federal Reserve is prepared to institutionalize lower rates as a way to lift lower-income Americans' wages, including racial minorities. China has continued to increase their global presence and influence the use of debt forgiveness and vaccine access in Africa. Africa as a continent represents dozens of votes in the United Nations and 1.2 billion people. It's no coincidence that China is focused on Africa for the Belt and Road Initiative. Certainly, the right-leaning Supreme Court will overturn the tax surcharge on investment gains of 3.8% as part of Obamacare. Our recommendations are to continue to rebalance back to policy targets, remain underweight developed markets, in particular European Union countries, as the fiscal stimulus they proved will be hard to deploy and Brexit controversies persist. Overweight emerging markets as valuations compared to earnings growth present a clear opportunity. We also would redeploy cash to reasonable low-risk alternatives to increase income. In terms of strategy update, I'd encourage you to review our discussion with China tech expert Kevin Xu on dispute between China and the U.S. on the technology sector. On behalf of all of us at Phillips & Company Advisors, I'd like to thank you for your time in reviewing our Q4 2020 look ahead. If you have any questions, please contact your advisor, or you can email me with the link below.